In this tutorial, I'm going to show you how to use Seasonax not just to find opportunities, but also to mitigate risk by identifying periods where historical data just warns you to be more cautious. Now, seasonality isn't only about spotting bullish buying patterns, it's equally powerful for recognizing when risk increases, when markets tend to fall, and when volatility tends to spike. So first of all, let's look at seasonality as a risk tool. Now, many traders use Seasonax to find strong seasonal opportunities, but an overlooked feature, and arguably one of the most valuable, is that Seasonax can also tell you when to reduce exposure, tighten risk, or perhaps avoid certain trading instruments altogether. So if a stock historically performs poorly during a very specific calendar window, that is meaningful information. Markets may change, but behavioral patterns repeat, and seasonality captures those tendencies. So let's look at historical downward trends as warning signals. Now, one of the simplest ways to mitigate risk with Seasonax is to search for seasonal downtrends. Periods of the year where an instrument just consistently loses value. So to do this, we open the screener, and then we're going to set the direction to the short side, apply our date window here, 1st of December 2025, that's just a particular window we're using, and we're looking at instruments over a 10-year period for between 31 and 60 days. And you can see here, look, if a stock consistently falls during a specific period, if it's 70, 80, 90% of the time, that is a major risk flag for anyone holding long exposure during that window. So here's Pfizer, and you can see that 80% of the time, Pfizer shares fall during this period. So let's open up the seasonal pattern. And what historically Seasonax is telling you here is that this is not a good time to be long. So you would want to consider reducing exposure, hedging, or perhaps tightening your stops. Now, there's two really helpful metrics that Seasonax reveals here, and that's the maximum drop metric and the maximum loss metric, showing you severe windows of danger. So let's look here. We've got this size of stock, and let's look first of all at the max drop feature, which is here on this drop down chart. This shows the largest peak to trough decline during the seasonal window, and it's across the entire history. So for instance here, you can see that the maximum drop, peak to trough decline here for 2017 was 2.34%. But yet the overall profit was 3.99%. So it just shows you the maximum drop during that period. And you can see here, look, the maximum drop over this whole seasonal period was 14.05% in 2018. Now, the other metric is the maximum loss metric. That just shows you the worst overall performance the pattern delivered in any single year. Now, these two figures really matter because they reveal, one, how deep the pattern can go against you, and how quickly a position could move into drawdown and how far. So it's the true range of historical downside. That's why I really like this max drop feature, because it shows you what is the true potential maximum loss at any given point during that seasonal pattern. You can see here, even though the maximum loss was 13.96%, you can see that actually there was an occasion when the maximum loss, peak to trough, maximum drop was 14.05%, even though the actual result was only negative 9.59%. So for risk management, always check the maximum loss metric and the maximum drop metric. It really helps you to understand what kind of risk you're potentially exposing yourself to based on historical volatility. Now, Seasonax doesn't just show you the returns, it also shows you how reliable those returns are. So this is where risk adjusted measures come in, especially the Sharpe ratio and the standard deviation. Now, the standard deviation reading here is really a consistency gauge. It measures how volatile the seasonal returns have been in the past. It sort of tells you how predictable or unpredictable the pattern is. Now, it matters for risk because when you have a low standard deviation, that's helpful because it shows you that generally the pattern is stable or predictable. When you have a high standard deviation, it shows you that the pattern return is volatile, inconsistent, and that's in keeping with high risk behavior. So you might have two patterns that offer the same average return, but one might have a high volatility and one might have a low volatility based on the standard deviation. So the rule of thumb is the lower this number is, the more consistent and reliable the pattern is, the higher it is. So if this is above 10%, treat this with caution. If it's below 6%, that's generally consistent. So if you want to mitigate risk using Seasonax, you want to favor patterns with a lower standard deviation, especially when entering seasonal trades with larger size or longer duration. Now, the Sharpe ratio answers a critical risk management question. How much return am I getting per unit of risk? So again, even if a pattern has a high average return, it becomes far less attractive if the volatility is high. And what the Sharpe ratio does, it helps quantify this by comparing the seasonal return versus the variability of that return. So obviously, a high Sharpe ratio is good quality, right? Because it's telling you that it's worth taking that risk based on the historical seasonality. If it's a low Sharpe ratio, that shows you that the performance is weak. And in this instance, right, where you've got a negative Sharpe ratio, that tells you that the seasonal pattern loses money on a risk-adjusted basis. So that's very helpful for us in this scenario. You can see actually, on a risk-adjusted basis, that this seasonal pattern holding Pfizer stock long over this period loses money. And we see here we've got a high standard deviation with a low win rate. That means that the pattern is historically both unprofitable and volatile. So it's the worst combination for risk. It's unprofitable, it's volatile. So you can see here, Seasonax is much more than a tool for just finding opportunities. It's a powerful way to identify risk, avoid historical weak windows, and choose trades with smoother, more consistent performances. So by analyzing downward trends, studying the maximum drop, the maximum loss, using risk-adjusted metrics like the standard deviation and the Sharpe ratio, can not only help you make decisions that improve returns, but it also can significantly reduce portfolio drawdowns over time. So seasonality doesn't just have to help you capture upside, it can also help you avoid danger to the downside. One final way that I like to use this kind of data, particularly this max drop metric, is say I have a bullish bias overall on a stock. And I'm just for the sake of argument, imagine that I really wanted to buy Pfizer stock and I was looking for an opportunity to get in. This kind of weak period would be ideal. Because I can see on average return it's 4.47%, and the maximum drop during this period was 14.05%. So that would tell me that if I got a drop of around 10%, potentially that would be the sort of area that I would be looking to buy in, because I know from a historical perspective, the maximum drop has only gone over 10% once, twice, 3 times. So if I did hit a maximum drop of 10%, that would offer a decent dip buying opportunity. And obviously if it went to sort of 13, 14%, then I'll be a very interested buyer based on the historical volatility. So it can also be used as a way of setting expectations for dip buying. Remember, don't just trade it, Seasonax it.